If you're serious about trading, the toughest part isn't writing a trend. The real challenge is knowing when that trend is about to flip, because the market never sends you a heads up. It kind of turns quietly. It starts breaking structure, and by the time most traders realize what just happened, they're already chasing the move. That's why today we're breaking down an open source indicator called Pivot Trend by my favorite, Chart Prime. This tool is designed for one main purpose, and that's helping you spot the real trend reversals based on actual market behavior. Structure pivots and not lagging smoothing like a moving average. It's built to show you when sentiment shifts, when the structure breaks, and where the new trend line is forming, so you can plan cleaner entries instead of buying highs or shorting lows. We're going to set it up on TradingView, which is the platform I'm using here. If you haven't signed up and want to follow this exact setup, there's a link waiting in the description below. Open TradingView, pull up AUD and ZD, and choose a time frame that fits your style. For this walkthrough, I'm using the 1-hour chart so you can clearly see the swings and the retests. Now, quick indicators. Search Pivot Trend by Chart Prime and add it to your chart. Once it loads, you'll notice two things right away: a trend line that changes color and position, and the buy and sell markers that appear when the trend flips. Here's what really separates this indicator from most others. The majority of trend tools rely on averaging price, which means they lag and they often get fooled by sharp spikes. Pivot Trend uses a structure-based approach. It looks for pivot points, meaning real turning points where price formed a swing high or a swing low. It does this by scanning the highest highs and lowest lows inside the window you control. Then it uses those pivots to map overall trend direction. So on your chart, that line becomes your trend guide. When the line is blue, it's telling you structure is bullish and the trend is moving up. When it turns red, structure is bearish and the trend is heading down. In a bullish trend, the line sits below price and acts like dynamic support. In a bearish trend, it sits above price and acts like dynamic resistance. That's why this tool is so useful for entries. Instead of guessing where support or resistance might be, you get a trailing structure level that updates as the market creates new pivots. You'll also see the signal markers. When the trend flips bullish, you'll see a clear buy marker printed on the chart. When it flips bearish, you'll see a sell marker. Think of these as alerts that the structure has just changed. But the real edge isn't blindly buying the second you see a buy marker. The real edge is using that new trend line as your retest level. That way, you enter after the market confirms the flip instead of chasing the first candle. Before we jump into this strategy, let's quickly walk through the settings. Because this is where you define what marker structure means to you. The first input is left bars. This is the number of candles to the left of the pivot that must be lower or higher for that pivot to count. In simple terms, for a swing high pivot, the pivot candle must be higher than the candles to its left. The second input is right bars. This works the same way on the right side. The pivot candle also has to stay the highest or lowest compared to the candles that form after it. This matters because it forces confirmation. It prevents the indicator from calling every tiny wiggle a pivot. So if you set the left bars and right bars to 10, the indicator will only mark a pivot if that candle is the highest high or lowest low across a 21 candle window. 10 candles before it, 10 candles after it, plus the pivot candle itself. Larger values mean fewer pivots and smoother signals. Smaller values mean more pivots and faster signals. The third input is offset. This is basically your sensitivity filter. If you're trading something volatile or working on a lower time frame, pivots can trigger way too often. Offset helps filter that out by requiring a more meaningful swing before a pivot is accepted. So here's how to choose your settings without overcomplicating it. If you're a swing trader looking for major structure turns, increasing left bars and right bars, you'll get fewer flips, but they'll carry more weight. If you're a scalper or short-term trader, lower them so the line reacts faster and gives you tighter structure levels for quicker trades. Then use offset to calm the tool down if it's firing too many pivots for your market. Now let's talk about the strategy this indicator shines at, which is trading the retest. When the market flips, the first signal is often the worst entry, because that's when everyone feels the fear of missing out. Pivot trend fixes that by giving you a dynamic support resistance line that trails with the new structure. Your job is simple. Don't chase the first move. Wait for the price to come back and retest that line, then enter when it holds. Here's the long setup on AUD MZD. First, you want to see the trend flip bullish. That means the line turns blue and you get the buy marker. This tells you structure has shifted and the market is trying to start a new uptrend. Second, you wait. Don't buy immediately. Let price move away and prove the trend. The clean setup usually appears after the first pullback. Third, you watch for price to pull back into the blue line, because in an uptrend, that blue line acts as dynamic support. This is the floor that must hold if the trend is real. Fourth, once price touches the line or comes close to it, you wait for a clear bounce. The simplest confirmation is a bullish engulfing candle, or at least a strong bullish candle that rejects the line and closes higher. That's your entry trigger. For risk management, your stop loss goes below the line and below the swing low created during the pullback. You want it placed where the trade is clearly invalid if price breaks through. For take profit, you can keep it simple and aim for 1.5 times your risk or target the next major structure level to the left. If the trend stays blue and price continues to respect that line, you can trail your stop under the line as it rises. Now the short setup is exact opposite. First, the trend flips bearish. The line turns red and you get the sell marker. This tells you a structure has shifted and the market is beginning a downtrend. Second, you wait for the first move down to play out. Again, you don't want to short the very first breakdown candle. Third, you wait for a pullback toward the red line. In a downtrend, that red line acts as dynamic resistance. It's the ceiling buyers need to break, and if they fail, the downtrend remains intact. Fourth, when price taps the red line or gets close, you wait for rejection. A bearish engulfing candle is ideal, or a strong bearish candle that closes away from the line. That's your entry candle. Your stop loss goes above the line and above the pullback swing high. Your take profit can once again be 1.5 times your risk or the next major support level to the left. And if the trend stays red and price continues to respect that line, you can trail the stop above the line as it steps lower. That's the core reason traders like this tool. It turns market structure into something visual and repeatable. You're not trying to predict reversals with a lagging average. You're watching price break the structure. You're letting the indicator draw the new structure boundary, and you're entering on the retest instead of the impulse. One more important rule. This is a confirmation tool, not the standalone system. The buy and sell markers are not meant to be taken blindly. Use them with context. Check nearby support and resistance. Look at the broader trend on a higher time frame. Use volume or momentum if that's already part of your system. This indicator shows you the structure shift, but you still want extra confirmation before putting money at risk. And that brings us to the final thought. If pivots are the purest expression of structure, what happens when a major news event hits and blows through weeks of clean technical levels? In those moments, the structure can break down fast. So as a structure-based trader, your job is to respect the line, but also respect reality. When volatility spikes and the fundamentals take control, don't treat any indicator like a guarantee. Use it as a guide. Manage your risk and stay flexible. This is not a financial advice though. Everything here is for educational purposes only. Always trade with a plan. Use proper risk management and test this approach on AUD and NZD before going live on any market. If you found value in this video, leave a like and consider subscribing to Income Nomad for more indicators and strategies and breakdowns and clean trading strategies. Thanks for watching, and I'll see you in the next one.